What's going on, everybody? It's Keith right here with Shaded Money, where we help you improve your financial health. Today I'm going to cover the 5 C's of credit. This is the formula lenders use to evaluate your creditworthiness and borrowing potential. Before we get started, if you're new to Shaded Money, then make sure you hit that subscribe button so you can stay up to date on all Shaded Money videos. When a person decides to apply for credit, whether it's a credit card, loan, line of credit, mortgage, car loan, etc., the lender or bank is going to look at 5 key factors, or 5 C's, to see how risky that loan actually is. They basically want to know how likely are they going to get their money back. The first C that we'll look at is character. This refers to a person's credit history or reputation when it comes to paying back debts. This involves a lot of the information that appears on a person's credit report. The lender will look for a FICO score, the amount of money borrowed in the past, if you paid your debts on time, if you have any charge-offs or collections, and a bunch of other things. This is very similar to the job hunting process. A new job will use your resume and interview to evaluate your professional reputation and character to see if you're a good fit for that job. The second C we'll look at is capacity. This C refers to a person's overall ability to repay back their debts. Lenders will evaluate this by using a number called DTI, or debt to income ratio, to calculate a person's monthly income versus the amount of money they owe. This is done by adding a person's total monthly debt payments and dividing that amount by the person's monthly gross income. So that number is the income amount before taxes or deductions are taken out. Lenders usually like this number to be around 35% or lower. Let's take a look at an example. If all of your monthly payments total $1,800, but your monthly income is $3,500, your debt to income ratio is 50%. Which may discourage a lender from lending to you because too much of your income is already dedicated to paying off other debts. Capital. This C refers to the amount of money a person plans to put down towards a particular loan or investment. Often, this is the down payment that may go into whatever it is that you're trying to finance. The amount of your down payment can affect the rates and terms of the loan, both positively and negatively. People doing larger down payments can get lower rates on the loan because the overall loan or investment that the lender is making is less risky. Ultimately, the lender is looking to see how much skin in the game you have, because that can help determine how likely a person is to default or walk away from the loan. If a person is making a down payment of $15,000 on a car that is worth $30,000, then the lender can evaluate that person's seriousness of repaying back that loan. Because in this case, the borrower wouldn't want to get a car repossessed for non-payment that they've already invested $15,000 in upfront. The same concept is applied to when you're buying homes and getting mortgages for homes. The fourth C is collateral. This C refers to the item that is being used to secure the loan. This is usually something that the lender will be able to repossess in the event that the person stops paying on the loan. In most cases, it is the item that the person is borrowing the money for, but it can range from many different things. For example, pawn shops allow people to use all kinds of things for collateral to secure their loan. Loans with collateral involved tend to be less risky to the lender because they will just take the car or house and sell it and at least make something back from the L that they took from dealing with you in the first place. The last C I'll cover is conditions. This refers to how the borrower intends to use the loan. Sometimes the lender looks for true valid reasons to give the loan based on the reason that the person is requesting it. The lender may also look at outside factors like current state of economics and other variables outside of the borrower's control. For example, let's say you owe $2,000 on credit card A, $2,000 on credit card B, $2,000 on credit card C. And you go into the bank and you want to apply for a loan of $6,000. And when they ask you for the purpose of the loan, you tell them because you want to take the $6,000 and consolidate some of your debt and pay off all 3 of the credit cards and have one lump sum payment to manage. most likely at a lower rate than you're paying on your credit cards, but that's a discussion for a later video. You are more likely to get approved for that loan if you indicate that you're using the loan for debt consolidation versus using it for traveling or something that would just be stacking more debt to what you already have. So there you have it. I just explained the 5 C's of credit that lenders use to evaluate your credit worthiness. I hope you got something out of this video, and remember to continue to research these topics on your own to maximize your own knowledge on these topics. If you want to keep the lights on at Shaded Money, please hit that like button and subscribe to the Shaded Money channel for more videos to help you improve your financial health. I'm King-Wright, and I'm signing out.